Hi friends, welcome to the channel Jaiib and CIV Made Simple. Have you ever wondered you could revise the entire unit 29 which is based on financial market in just 10 minutes? Now it is possible. This video is in front of you and now we are going to revise our unit number 29 in just 10 minutes. Just spare your 10-minute valuable time and you will be able not only see the ultra micro notes because the notes have been condensed in fewer words and everything have been covered, and also you will do MCQs also in the next 10 minutes. So gear up in the next 10 minutes, revise the concept, listen to each and every word and do MCQ. I guarantee unit 29 will be easier for you now. Let's begin with. First of all, financial market are places where wealth moves from saver to the investor. So wealth move from saver to investor. Think of it as a platform for trading goods and services where prices are based on supply and demand. Prices are determined based on supply and demand. There are different kinds of financial markets like credit market, money market, forex market, that is called foreign exchange market, debt market, capital market, derivative market and insurance. Next thing is how financial market evolved in India. Before the 1990, the system was pretty restricted. Right, the system was pretty restricted, pricing was controlled, liquidity was low and the costs were high. But after 1990, things changed with reform to make the market more structured, efficient, stable. Now what are the key reforms? So the key reforms include free pricing of asset, removing restriction, new way to issue securities, allowing more player and financial tool to enter into the market. These were the reforms. Then after, trading and settlement process were also improved, making the market more transparent. Now let's take a closer look at the different segment of the financial market. First up, we have several key segment. This question is asked every year: money, forex, capital, insurance, credit, derivative and mutual fund. Credit market. This involves things like debt security and loans. Money market. This focuses on short-term debts, especially like treasury bills and commercial paper. Debt market. Here we deal with long-term debts like bonds and notes. Forex market. This is all about currency trading. Derivative market. These are instruments based on other assets like options and futures. Capital market. It deals with long-term securities like stocks and bonds. Insurance market. This is where insurance products are traded. Mutual fund market. This is all about mutual fund investment. Each of these segments serve a unique purpose in helping businesses and individuals manage their finance. Now let's break down three important segments of financial market, that is our money market, debt market and forex market. Money market deals with the short-term fund and play a big role in managing country monetary policy. Some common instruments here include, this question is asked, call money, certificate of deposits, treasury bill, repo, banker acceptance, commercial paper and inter-corporate fund. A key private instrument in this market is commercial paper, which help companies get quick access to cash. The debt market also has two main parts. First is government security. Government security are the bonds which are issued by the central or state government and can be traded. Next is corporate bond. These are long-term bond issued by company to raise fund. Next we have is forex market. The foreign exchange market involve banks, customers and the Reserve Bank of India. It has grown significantly since 1978 with daily turnover from $6 billion to $70 billion. So that's a quick look at how this market work. Now let's quickly talk about the derivative market and mutual fund. Derivative market is where the value of contract changes based on factors like interest rate, security prices, commodity prices, foreign exchange rate, stock indices or credit rating. It is all about betting on how this thing will move in the future. Mutual fund. See, a mutual fund is like pool of money that people invest. It is managed by professional fund manager via AMC, working under asset management committee. This money is invested in various things like stock, bond, and equities and many money market instrument. After deducting expenses, the income is distributed proportionally to the investor. There are two types of mutual fund scheme, and the fees are regulated by SEBI, that is Security Exchange Board of India. There are two types of mutual fund scheme. One is called open-ended. These don't have a fixed maturity period, and second is closed-ended. These have a fixed maturity period. Mutual fund offer direct and regular plan, right? And the market, their fees are regulated by the SEBI, the market regulator. SEBI even allow schemes like real estate and infrastructure debt fund. Mutual fund are more popular among individual firms, banks and companies because they compete with bank to raise the funds. So this is all about the mutual fund. Simple overview. Now let's talk about financial market or function and how the price discovery work. So function of financial market, they help in price determination, meaning the price of asset are set based on supply and demand. Next thing is fund allocation is another function where money is directed toward investment that offer the required return. The third thing is financial market also provide liquidity, making it easier for investor to buy or sell asset quickly. Lastly, they also allow for risk sharing, meaning risk are spread between investor and entities. Now financial market overall connect buyers and sellers, making it easier to access trade asset and making it easier to access and trade asset. They also help reduce transaction cost and give investor important information. Price discovery is the process where the asset prices are determined by the interaction between the buyers and seller. Key factors include supply and demand, how much risk people are willing to take, market volatility, and the information available. Market mechanism also play a big role in setting our price. So that's how financial market function and how price are discovered. Now let's dive into few more key concepts related to how price are set in the financial market. Equilibrium. This happens when the supply is equal to demand. At this point, the price is considered fair. Next thing is risk attitude. The way people feel about risk affect whether they are agree on price. Some may be willing to pay more if they are less worried about risk. Next thing is volatility. If there is more volatility in the market, meaning big swing in the price, there is high chance for profit, but also a better risk for loss. Information. Market decisions like buying and selling are strongly influenced by information. For example, announcement from RBI can change how people trade. Next thing is supply and demand. These two factors are crucial in determining asset prices. When demand goes down, supply goes up, price tends to fall. Right, price tend to fall. Price discovery and equilibrium. When supply and demand cross over, you get the fair price, but any shift in supply or any demand start the price discovery process all over again. So in a nutshell, the market price is always adjusting based on this factor. Now let's do some MCQs based on what we have covered till now. The first question is in front of you, that which of the following statement best describe the key characteristics and evolution of the financial market in India? Option A says financial market facilitate wealth transfer, provide price control mechanism and operate through a credit and insurance market only. So this option is wrong, because financial market involve more than just credit and insurance market, because this only word is wrong. And there is not price control but rather price determination. This price control word is also wrong. There is price determination. Option B says financial market allow the exchange of goods and services, have evolved significantly since 1990 and have introduced reforms like free pricing and increased transparency. So option B captures the evolution of Indian financial market post 1990 with key reforms like pre-pricing and transparency. This is the correct option. Option C says pre-1990 financial market in India were highly liquid, had low cost and allow for free pricing and market integration. This is incorrect, because pre-1990 financial market has restriction, they have low liquidity, they have high cost, which changed with reform. So this is wrong. Option D says the evolution of the financial market post 1990 restricted asset issuance, reduced market participation and eliminated free pricing mechanism. This is also incorrect, because the post 1990 reform actually promoted free pricing. It has increased market participation and it has enhanced asset issuance. Now let's move on to the second question. The second question is, which of the following correctly identifies the segment of financial market and their respective function? A says, the capital market deals with short-term securities like treasury bill and the insurance market handles long-term instrument. This is incorrect because capital market deals with long-term securities like stock and bond, while the insurance market deals with insurance product, not long-term debt. Option B says, the money market handles short-term debt instrument, while the credit market focus on long-term debt and loan. This is incorrect because money market handles short-term debt instrument, while credit market deals with both short term as well as long term debt including loans. So this is incorrect. Option C says the derivative market is concerned with instrument like option and future based on underlying asset, and the mutual fund market deals with mutual fund investment. This correctly identify the derivative market and as well as mutual fund market. So this is the correct answer. Option D says the forex market handle long term securities and the debt market focuses on currency trading. So this is also incorrect because the forex market deals with currency trading and the debt market handles long term net. So this is wrong. Forex market deals with currency trading and debt market deals with long term debt and instrument like bonds. So the option D is wrong. Let's move on to the next question. Which of the following correctly describe the future of money, debt and forex market? Option A says money market deals with long term government bond and the debt market focus on short term instrument like treasury bill. This is incorrect because money market deals with the short term instrument like treasury bond, not long term government bond, which are the part of debt market. Option B says corporate bond and government securities are the key instrument in the money market and the forex market was developed before 1978. This is incorrect because this corporate bond and government securities are key to the debt market, not to the forex, not to the money market, and the forex market developed post 1978, not pre 1978. Now option C says the money market handles short term instrument like call money, commercial paper, while the forex market include bank customer and the RBI with significant daily turnover growth rate since 1978. So this is correct. It actually describes the money market handles short term instrument and the forex market including bank and customer with substantial growth in turnover since 1978. This is the correct answer. Option D says the debt market primarily consists of commercial paper and repos and the forex market involve inter-corporate fund trading. So this is incorrect because debt market primarily consists of long-term debt instrument like corporate bond and government security, not this short-term instrument, and the forex market deals with currency trading, not inter-corporate fund trading. Right. So this is option number C is correct in this particular question. Let's move on to the next question. Which of the following best describe the future of derivative market and the mutual fund scheme? Option A says the derivative market is driven by the underlying changes in the interest rate and prices, while mutual fund pool money to invest in equities, bond and other instrument with income distributed proportionally. So this is the correct. It correctly describes the derivative market is influenced by changes in interest rate and pricing, while mutual fund pool money for investment. Option A is correct. Option B says mutual funds are regulated by RBI and the derivative market is solely dependent on security prices. This is incorrect because mutual fund is not regulated by RBI. This is regulated by SEBI and the derivative market is influenced by multiple factors, right, beyond just security prices. Option C says mutual fund scheme are entirely close-ended while the derivative market is regulated by SEBI and based on credit rating alone. So this is also incorrect because mutual fund market can be open-ended also and close-ended also, whereas derivative market is regulated by SEBI and not based on credit rating. So this is wrong. Option D says the derivative market is based on fixed maturity instrument while mutual fund operate in open-ended scheme offering guaranteeing return. This is incorrect because derivative market is not based on fixed maturity instrument and mutual fund offer various scheme, not just open-ended alone. Now let's move on to the next question. Next question says which of the following correctly outline the function and characteristics of financial market including price discovery? Option A says financial market mainly focus on reducing volatility and risk without playing a role in the price determination or liquidity provision. This is incorrect because financial market do play a role in price determination, liquidity provisioning and risk sharing, not just in reducing volatility and risk. Option B says financial market facilitate price determination, fund allocation and liquidity, enable risk sharing with asset prices determined through supply demand interaction and factor like risk, attitude and volatility. This is correct. This is absolutely correct. Option C says that Price discovery in financial market only depend on transaction cost and supply with no influence from risk, attitude and volatility. This is incorrect because price discovery depends on various factors including risk, attitude and volatility, not just transaction cost and supply. Option D says financial market ensure that asset prices are fixed and do not fluctuate based on supply, demand, charge or market information. This is incorrect because the asset price in financial market are not fixed. They fluctuate based on supply, demand interaction and market information. Let's move on to the last question of this particular session. The last question is that which of the following factors significantly influence impact price determination and discovery in financial market. Option A says only the quality of supply affect asset price and the demand has minimal influence on price movement. This is incorrect because both supply and demand significantly affect asset price. Demand is just as crucial as supply in determining price movement. Option B says information such as RBI announcement along with shift in supply demand plays a key role in price determination, whereas decreased demand and increased supply lead to price fall. So this is accurately highlight the information such as RBI announcement along with change in supply and demand are crucial for price determination. For example, a decrease in demand combined with increase in supply generally lead to fall in price. Option C says price equilibrium is irrelevant in financial market and new supply demand shift do not impact price discovery. This is incorrect because price equilibrium is very relevant in the financial market and the shift in supply demand do impact price discovery. What does option D says? Let's move on to the next slide. Option D says that price discovery is solely based on availability of supply and demand shift have no role in affecting asset price. This is also incorrect because price discovery involve both supply and demand factor. Shift in either can affect asset price. So friends, this was all about our unit number 29. Hopefully I have covered the important parts and theory and MCQs. If you want PDF of this, you can enroll in our IE&IFS capsule course. This is the part of our IE&IFS capsule course. And if you really enjoy the video and if you want me to bring more such videos for race topic, please write in the comment section part 2 or yes. Simply write yes, I will understand that you want such lecture for other part also. Thank you.